Hi, Nathan here from Buyers Club. Despite being a few weeks ago now, the recent federal budget and its impact on the property market is still a big topic, and a lot of really interesting modeling has come out in the past couple of weeks. So, in this video, I want to take you through a few of the interesting findings that have come out lately and discuss where exactly the market seems to be heading. First up is Westpac's recent housing forecast update. And a big finding here is that they're expecting overall investor activity to fall. You can see here from the report that, of course, on the back of interest rate hikes as well, Westpac expects new investor activity to fall by up to 34%, with what's left skewing more towards new builds than in the past, thanks to those continued tax incentives for new builds. And the chart that they've included here shows the level of financing for new builds that investors are responsible for, along with Westpac's forecast for the next few years. So historically, investors have made up about 20% of financing for new builds. But you can see they're expecting new builds to become significantly more popular among investors, with property investors making up about 40% of new build financing by 2029. Overall, though, beyond just investor activity, Westpac also sees total housing market turnover falling by 20%. And I think this is an interesting point to focus on. Most property analysis tends to focus just on prices. Will they rise? Will they fall? But turnover is really important as well because it tells us how many people are willing to buy and sell property. So a decline in turnover tells us that fewer people are looking to buy. And for existing investors with these recent changes, there will be more of a reluctance to sell because of the grandfathered access to negative gearing. So for those fewer properties that do end up on the market, sellers are going to have less negotiating power with fewer people competing for their property. That doesn't necessarily mean a collapse in prices. And in fact, Westpac is still forecasting pretty strong growth in a number of markets, as we'll see. What this could create, though, is a more favorable environment for investors with a sound strategy. There will be fewer active buyers competing for properties, so investors who have done their research and understand the underlying fundamentals may find more opportunities to negotiate effectively and get into quality assets without facing the same level of competition that we've seen in recent years and risk overpaying. But of course, the big question that we care about is what this means for prices, and Westpac's forecasts are really interesting on that too. Maybe surprisingly, Westpac isn't forecasting a nationwide collapse in values, and the city by city forecasts are definitely worth looking at. Sydney is expected to fall by 3% in 2026, and Melbourne is expected to experience a slightly bigger decline of 4%. But if we look beyond Sydney and Melbourne, the situation is pretty different. Brisbane is still forecast to return 9% growth in 2026, Perth 13%, and Adelaide 7%. So if you looked just at Sydney and Melbourne, it looks pretty poor. And even the national figure for growth is just 1%. But there's still expected to be major markets across the country that outperform their 10-year average for growth in 2026. If you look at the left column here, the average annual growth over the past decade, Brisbane's been 7.8%, Perth 6.8%, Adelaide 7.5%, and Westpac still expects all three of these cities to outperform those averages this year, despite the negative sentiment, despite interest rate hikes, despite all of the budget alarmism. So if you can get in now and you're able to navigate some of these more challenging conditions with the right strategy, there still are opportunities to get into high growth markets despite this dip in activity and reduced competition from other buyers. And in addition to these short-term conditions, all signs still point to housing supply actually getting worse in the years ahead. So the structural appeal of property investment has not really changed a whole lot. We've just seen more modelling come out looking at the impacts of this budget on housing supply from Master Builders Australia. And unsurprisingly, the finding is that softening price growth will actually cut new supply by more than 8,700 homes over the next 4 years. And it looks like renters are really set to suffer the most. 4 years from now, the expectation is that rents will have risen by an additional $421 a year off the back of the government's changes to negative gearing. Already, we're seeing that rents are accelerating even before these new tax policies have fully come into effect. Rental growth for houses has been accelerating for about a year already now across most capital cities. As you can see on the left here, this is Cotality's annual change in rents data for housing markets. But besides all of this is the ongoing question of construction costs too. As we saw, Westpac expects investors to pile into new builds, but a lot of these new forecasts are pretty concerning for housing supply, now looking at the impact of the war in Iran. This is some new forecasting from CBA, who have now adjusted their housing supply expectations down significantly following the war, as shown in the blue line here. And there doesn't really seem to be any signs of housing supply getting anywhere close to the Housing Accord target, way up there in the red at 240,000 new homes a year. And this is again backed up by the RBA. This is forecasted private dwelling investment. And in the red here is the Treasury's forecast that was contained in the budget papers, plotted against this new modelling from the RBA in the blue, who are clearly a lot more pessimistic about investment into housing. And really, this makes sense. It's hard to see how investment and construction is going to increase alongside higher interest rates, huge construction cost increases, and at least for the time being, a softening in overall house price growth. So when we put all of this together, there seems to be a pretty clear distinction emerging between the short-term and the long-term outlook for property. In the short term, conditions are likely to be a bit more challenging. Investor activity is expected to fall, turnover is expected to fall, and higher interest rates will continue to weigh on the market. But Australia still faces a significant housing shortage, population growth continues to add demand, and increasingly major institutions, as we've seen, are forecasting that supply will continue to fall short of what's actually needed. So while activity may slow in the short term, the underlying supply and demand imbalance isn't going away. And I think that's what makes this period particularly interesting for investors. When sentiment weakens and competition falls, opportunities often emerge for buyers who are focused more on the long-term fundamentals rather than short-term headlines or alarmism about the market. So I think the biggest takeaway from all of this is this tension between short-term headwinds versus a long-term housing shortage that is actively getting worse. I would suspect that much like we saw in 2022 when prices dipped, there will be plenty of people a few years from now wishing they'd been less focused on the headlines and more focused on some of these fundamentals. Let us know your thoughts though. What do you make of these new forecasts and where do you expect house prices to go in the short term, long term? Let us know and we'll see you in the next video. Thanks.